Welcome to SB Talks. Today is Tuesday, the 25th of February, and I am joined as ever by our trusty Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing European economics and geopolitics, where to from here for the RBA after last week's cut, and a global equity update. Welcome to all our listeners. Let's start in Europe this week. A lot of attention on the German federal election over the weekend, and it's fair to say it's a continuation of a trend which has seen voters somewhat unenthused with their economic climate, reaching more to the extremes in terms of the parties that they have voted for.
Yeah, well, we saw the Olaf Scholz's SPD, which was he was the currently
incumbent.
The incumbent
Yeah.
Was the worst post-war election results. They came third with 16.4% of the vote, and we saw a swing to the far left and the far right.
Yeah.
Notably AfD, Alternative for Deutschland or Germany. Yeah, they did pretty well. Almost 21% of the vote.
So it's got shades of the French election here, albeit a slightly different process, where they sort of the French voting public swung to the left and to the right first, and then to the left over the course of their elections last year. I guess Germany, we've talked about it here before, sort of in a sort of certain economic slowdown, or maybe stagnation is possibly too tough a word, but that's probably been reflected in the voters' experiences and how they've gone to the polls. Challenge now, maybe, not to delve too deeply, but where to from here? Because I know they have to try and now piece together a coalition. And what's some of the potential economic challenges that will pose for them?
Yeah, so the Friedrich Merz's CDU-CSU bloc will try and form a coalition. They're trying to do that, have that all bedded down by Easter, so the next couple of months. Most likely coalition partner will be the SPD. Although, it's of an unstable alliance.
What flavours of politics for the listeners does that give us in the coalition?
It's fairly sort of probably centre-right.
Yeah.
Given, the CDU is a conservative party. They went to the polls with a sort of a more anti-immigration, not as extreme as AfD, but certainly, that's on the agenda, as is more defence spending is certainly something that they're trying to arrange. I think the big thing from an economics perspective is Germany needs to loosen the purse strings. So their economy is really stagnated over the last 3 years. They're facing into problems in China, which is one of their major
industrial exports to China, down, reflecting some of the weakness in the Chinese economy.
Well, that's right. And then, this whole EV growth in Chinese EVs, where, BMW and VW and Mercedes and Audi and VW all sort of not really
struggle
competitive.
To keep up and compete. Yeah.
So there's that headwind. There's a headwind of potential US tariffs that we know are coming, would potentially impact the auto industry. So there's that. There's the fact that there's no longer that cheap Russian gas coming in that was powering their industrial economy. So they have this thing called the debt brake. The debt brake requires a 2/3 majority in Parliament to increase. So the talk is that they might try and use the current Parliament to increase the debt brake and loosen the fiscal purse strings before the new government sort of takes effect around Easter.
Yeah, so sort of shades of the US debt ceiling here.
Yeah.
Obviously different political mechanisms in terms of how you approve that. I guess your challenge that you pose there is 2/3 majority, and as the more fragmented, I guess, the Parliament or the voting mechanism becomes, the harder it is to reach that sort of quorum.
Yes, exactly. So that's why they're trying to potentially lock it in now before before these minor parties, which will hold more than 1/3 of the Parliament, come into power.
Now, you spoke briefly there, I guess, about potential spending and the building up of defence spending. We've had quite a bit of activity surrounding Ukraine in the last week or two, and obviously this week marks the 3rd anniversary, I think, of that conflict, which is pretty sad that we've managed to still be at this point, and it's continuing on. Any comments that you would make around there?
Well, there's obviously been, some outrageous claims by Trump that, Zelensky started the war.
Standard stuff, really. Yep.
Probably they're designed to put a bit of pressure on Ukraine to come to the negotiating table, or at least agree to whatever Trump and Putin kind of can work together. It does.
We see the US also put a bit of pressure on Ukraine about some sort of rare earth for cash deal as well.
Yeah. They obviously want access to some of those critical minerals, rare earths, lithium and things like that. So, question how that would all work. But I think it's all in the mix. And I guess I'm reasonably optimistic that I think that maybe there can be a deal done. Particularly in the last 24 hours, Trump's indicated in his meeting with Emmanuel Macron that the Russians would allow European peacekeepers to remain in Ukraine, not at the front line, but there to kind of, guarantee the peace and provide Ukraine with some sort of security guarantee. We'll see how that works, but that had been a bit of a red line before.
That was major stumbling block.
Yeah, so if they can agree to that, then perhaps there is a deal to be done. And the UK and France have indicated they're willing to supply troops,
peacekeeping forces.
Yeah.
And I guess we have no necessarily core value add in terms of the nature of that deal and the rights and the wrongs, but it would potentially be a positive, certainly to Europe, to remove that cloud of what's going on there, even beyond the sort of the horrible humanitarian situation, just in terms of flow of commodities, of resources and things of that nature back into that economy.
Yeah, absolutely. And I think we've seen, for example, the German stock markets perform very well in the last sort of few weeks, as people think, oh, wow, this could be, there could be more military spending, there could be more spending on the rebuilding of Ukraine, and potentially some of that cheap Russian gas can flow back into Europe.
Into their system.
So that's positive as well.
Rebuild of the industrial base there.
Yeah.
So I guess early days. We flag it, but I guess anything that sees the end of conflict is certainly generally to be welcomed. I'm conscious that I don't want to make this podcast into just the Donald Trump update, but so we'll not do that. But you commented when we were chatting this morning about some interesting U.S. consumer expectation survey data and how it just gives maybe a little bit of a feel to how the consumer on the ground in the U.S. is reacting to the rapidly evolving policy status of the new administration.
Yeah, it's interesting. There's the University of Michigan has been doing this long-running consumer sentiment survey, and the most recent one saw a decline in consumer expectations for how the economy is going at the moment and what the expectations of it will be in the future. So that fell 3 points to 64.7, which is the lowest since late 2023, which is, given everything that's going on, is I guess a little to be expected. So consumers are a bit worried about the economic outlook in the US, given all the noise around tariffs and immigration and deportation and Doge and all that sort of stuff. But interesting for me is one of the questions they ask in the survey is, what do you think inflation will be in a year's time? And what do you think it will be on average over next 5 to 10 years? And both of those went up. So consumers now expect inflation to be 4.3% over the next year. Over the
12-month period.
Yeah, and 3.5% over the 5 to 10 year horizon. Now that's the highest number since 1995. That 3.5% over the 5 to 10 years. So, I mean, it's consumers. Interestingly, it does kind of reflect party lines or voter patterns. So Democrats and independents are probably the most pessimistic and the most worried about inflation. But it is something that the Fed does keep an eye on, because if people think inflation is going to be higher, then they'll ask for bigger wage rises, and it can become self-fulfilling. So it's just something to keep an eye on.
Perhaps the message beginning to filter through there that tariffs, can be something that we're paying, not necessarily that the people that are sending the goods across are paying. But as the Fed's already probably managing a fairly complex moving target when it comes to interest rates, so it's just another thing in the mix.
Well, it is, because if there's any kind of weakness, but people's expectations of inflation haven't come down, it just limits their ability to cut rates, you know. So it's just something to kind of keep an eye on.
It probably reinforces a scenario where they're probably just going to be quite cautious on rate cuts from here, full stop.
Absolutely, yes.
Closer to home, we got the sort of rate cut that I don't know that we needed to have, but everybody decided we were going to have, and we got it.
Well, that's right. Yeah, it was 90% priced. So, and you know, most of the major economists were predicting it. I think we've spoken about this before. Maybe I said it was probably a more of 50-50 proposition, and I think, you know, when it came out, that was definitely the message from the RBA, was that you know, it was what we'd call a hawkish cut. So they cut, but then they really didn't give any sort of encouragement that there'd be subsequent or follow-up cuts anytime soon. So, and I think that's Michelle Bullock sort of repeated that messaging in the press conference after the meeting, but also when she appeared before Parliament late last week.
Yeah, and that's really important, because often in the past, when you start to enter into a cutting cycle, you're going to get 1, 2, 3 cuts pretty quickly into that, and it's probably the cumulative impact of those cuts that really has the impact. Here, as you described, they're really quite cautious about what they're saying. Yes, they've got a cut, but, you know, don't really bank on anything necessarily from here.
Yeah, and market pricing had 3 cuts over the next year or so.
Yeah.
And she really sort of said, well, if we were to do that based on our modelling, trim mean inflation would only come back to 2.7% over our forecast horizon, not 2.5, which it was previously. So what she's saying is, if we cut too quickly, we won't get the job done on inflation, you know. So that's why she's really trying to push back on those sort of their expectation of follow-up rate cuts. They'll be very data dependent. The key things she's looking at are ongoing disinflation in housing costs. You know, we've spoken about that before. Construction costs have kind of come down. That's good. So she'll want to see that continue, and rent. The second thing she's looking for is that the labour market is not inflationary, and that wage growth is coming down. And we saw some evidence of that last week, where wage growth slowed from 3.5% to 3.2%. And it's the slowest quarterly growth since sort of late 2022, I think.
Yeah, what's your take on that? Because unemployment remains sort of, let's say, beneath long-term trends. The jobs market is strong, without a shadow of doubt, but we're sort of seeing wage growth possibly come back from sort of the more robust levels it had shown over the last 2 or 3 years. How do you balance those two?
Yeah, I think it's the mix. You know, a lot of the jobs have been created in what they call the non-market sector. So it's things like healthcare, aged care, childcare, government services, etc. So sort of like public sector or adjacent to the public sector, and that's where all the jobs growth has been. And it's the wages there. There isn't that excess demand that we had a few years ago, where there were huge shortages, and so it just seems like it's not creating wage growth. So wage growth in the public sector was let's see, it was 0.6% for the quarter and 0.7% for the private sector.
Right.
You know, so
much more moderate, and potentially immigration is reaching a certain degree of equilibrium there, where it's sort of, we'd obviously a huge influx of people, but maybe it's sort of meeting demand, but not excessively so. Yeah,
and that I think is the big question mark for the RBA. You know, they were just always describing the labour market as too hot, too tight, but now we're saying, well, maybe, you know, it's not creating wage growth, it's not inflationary. So if that continues, then I think the RBA will be happy to put through another cut.
To move again.
And the other thing she talked about is what, you know, she calls non-market services. So that's the sticky services part of the economy where, you know, inflation has been slower to fall.
Not a huge data set, but over the last few weeks, we've sort of seen a moderate move away from sort of where the US market, and certainly the Mag 7, had significantly outperformed every other sort of part of the share market. Seen some other areas play a little bit of catch up. I'm conscious that it hasn't been a huge time frame though.
Yeah, so the Mag 7 have sort of really stalled over the past few months. Partly it's that DeepSeek, partly it's the quarterly results where the results were fine, but they weren't, they didn't shoot the lights out.
And they made big commitments of capital spends.
Huge capital spending commitments, $330 billion for the year ahead. So I think the market's just saying, well, yeah, there's nothing wrong with those companies, but they're not continuing to bid them up. And then, I mentioned the German stock market has gone on a bit of a tear. Chinese stocks have actually done pretty well over the past, month or so, partly due to that DeepSeek.
Yeah,
success.
After a long time sort of in the doldrums.
Yeah, so it's early days, short-lived, and I think it's healthy that there's a rotation into other parts of the market that are maybe cheaper. So we'll see.
We'll watch this space, I guess.
We'll see, and even our own CBA, has come back a bit in the last week since its results. After hitting, I think it was $167 or so. So
it's priced on an incredible multiple relative to growth there. So I think that possibly seemed like it had to come at some point. Anything catching your attention that you're anticipating coming up over the next couple of weeks? Obviously, we could potentially see an election announcement here.
Yeah, I'm not sure about that. I think they'll probably wait and go full term. So I still think the money's on a May election. The things that I'm looking at is we've got NVIDIA reporting later this week, so that'll be keenly watched. Are those chip sales continuing at the same brisk pace that they have been?
It's also not just for the NVIDIA's share price, but also it's seen as a little bit of a bellwether of what's happening with the spending and the capital investment across the board in AI.
Yeah, so that'll be keenly watched. We have the Chinese Two Sessions, which is their sort of annual kind of meeting where they announce growth targets for the year ahead. So they'll probably announce, GDP of around 5% and a fiscal deficit of around 4%, something like that. Right. So that'll be interesting to watch. And core PCE, which is the Fed's preferred measure of inflation, for January, which is expected to come in at 0.3 and 2.6. So they're sort of the key things I'm looking at over the next couple of weeks.
Yeah, there'll be a likely lead into how the Fed approaches from here. Excellent summary as always, Nick. Thank you very much. And thank you to all our listeners.
Thanks.